Good evening, everyone. Speaking on behalf of CAMS, I'm Lalit Jaising from Concept PR and your moderator for this virtual broker and analyst event. I would like to take this opportunity to thank you for taking your time from your busy schedules to join us. We appreciate your presence and extend a warm welcome to all of you. The objective of today's live session is to understand CAM's interest in raising finance via an initial public offering and what they do as a business organization. Under a normal circumstance, this would have been an on-ground event, but we are all increasingly getting accustomed to the new normal and are accepting digitization by communicating a transaction via digital mediums. We hope you gather the same or a better experience from the comfort from your home or office. Before we go further, I would want to review the functionality of the webinar. You will be kept on mute throughout the event and all questions will be answered via the Q&A chat box only, where you can type your question in session or at the end of the webinar. Would request all participants to please limit yourselves to 3 questions if possible and use a lowercase font when typing the question. If we miss any of your questions, don't worry. You can email us at ipoteam@conceptpr.com and we will try to be swift in responding back to you. Moving ahead, it's a great pleasure to introduce our speakers today. From the company, we have Mr. Anuj Kumar, Chief Executive Officer, and Mr. M. Somasundaram, Chief Financial Officer. The representation of the bankers are Mr. Viren Jairath, Vice President, Kotak Mahindra Capital Company Limited, Mr. Jagat Dave, Head Fixed Services Advisory, HDFC Bank Limited, Mr. Gaurav Sood, Senior Vice President, ICICI Securities Limited, and Mr. Sumit Sukramani, Executive Director, Investment Banking Division, Nomura Financial Advisory and Securities India Private Limited. On behalf of the company and the lead managers to the issue, let me thank all participants for being a part of this session. And now I invite Mr. Gaurav Sood from ICICI Securities to deliver the opening remark and commence this brokers and analysts conference.
Thank you, Lalit. So I would like to, on behalf of CAMS, I would like to welcome the broker and the analyst community to this event. Good afternoon, good evening, ladies and gentlemen. On behalf of CAMS and the book running lead managers to the issue, I would like to welcome you all to this conference and introduce you to the company. My friend Lalit has already introduced the panel and everyone present on the dais. So I will directly deep dive into a brief introduction about the company and its key strengths. CAMS is India's largest mutual fund registrar and transfer agent with over 2 decades of experience. It's a technology-driven financial infrastructure and services provider to the mutual fund industry and other financial institutions, including alternative investment funds, insurance companies, banks, and non-banking finance companies with over 2 decades of experience. Just to give you a glimpse of the scale of operations of CAMS, CAMS services 4 of the largest 5 mutual funds, as well as 9 of the 15 largest mutual funds based on average AUM during July 2020, according to CRISIL. The company has serviced 19.2 trillion INR of average AUM of 16 mutual fund clients as of July 2020, according to the CRISIL industry report. The company's mutual fund clients had 19.77 million SIP accounts as of June 30th, 2020, in which the company has handled 237.5 million transactions in the financial year 2020. It has 39.8 million live investor folios as of June 30th, in which the company has handled 320.4 million transactions in financial year 2020. some of the highlights and the key strengths of CAMS, which I would like to bring in front of you. CAMS is the largest infrastructure and services provider in a large and growing mutual fund market. CAMS has an aggregate market share of approximately 70% based on mutual fund average assets under management, managed by their clients and serviced by them during July 2020. The company has built an integrated business model with long-standing client relationships in its mutual fund services through diverse portfolio of technology and technology-enabled services and pan-India physical network. CAM's competitive technology advantage stems from scalable proprietary platforms which will deliver breadth and quality of service and cost efficiencies. Strong focus on processes and risk management has allowed CAMS to become a trusted provider of services to its client and its other stakeholders. The company is backed by an experienced management team with extensive experience in a variety of financial service sectors, with a demonstrated ability to grow and diversify our businesses and innovate the company's services. The company's key management personnel have an average work experience of over 27 years and have been with the company for over 5 years. Now coming to the detail of the issue. The IPO consists of issue of 1.8 crore equity shares through an offer for sale, aggregating to 2244 crores at the upper end of the price band. The price band is 1229 to 1230 per equity share of face value of rupees 10 each. The offer would constitute 37.4% of our post-offer paid up equity share capital. The anchor book of the IPO opens on Friday, 18 September, and the main issue opens from Monday, 21st September 2020 and closes on 23rd September 2020. With this, I now request Mr. Anuj to say a few words, followed by a presentation on the company. Thank you.
Thank you, Mr. Soop. That was pretty detailed. It's made it easy for Mr. Anuj and Somasundaram to, come back. Now I would request Mr. Anuj Kumar and Mr. Somasundaram to take us through the organization's journey, its struggles, victories, subsequently take the attendees through the company's investor presentation to cover its business and financial details, as well as touch upon its key strategies going forward.
Sure. Thank you. Thank you very much, Lalit. Thanks, Gaurav, for that very nice introductory speech of yours. And my deep, heartfelt thanks to everyone in the analyst and broker community who've kind of taken the time to be with us today. And it is a privilege to be able to present the credentials of CAMS to all of you together. CAMS, as you know, is the largest mutual fund registrar and transfer agent in the country. Been in a leadership position in this competitive industry for the last more than 15 years. And I've occupied almost 50% and greater share of the market for over a decade and a half, incrementing our share from that level to now almost 70%. And this increment having been more accentuated in the last 5 years. Very, very technologically oriented operation. We look at ourselves as a technology enabled platform and infrastructure services provider. That's a core business. And we've been serving the Indian mutual fund sector, as you will see in the presentation, almost through a very large array of offerings, which kind of takes care of every part of the operation that the mutual funds end up doing on the liability operations side. Indian mutual funds, as you know, kind of outsource the scope almost 100%, which means every mutual fund in the country buys this set of services from an R&T agent. They don't make it themselves, and they've been outsourcing this from almost day one, which means when the mutual fund started business, the first transaction was done by the RTA by us on their behalf. The first customer was onboarded by us. The first KYC was done by us. And that has left the mutual funds a lot of time and a lot of space to kind of focus on their core business, which is research, stock selection, finding the right securities, investor education, risk management, distribution, branding, those kind of things. And then left this vast spectrum of operational work on the liability side of operations to an RTA agent. And we believe that that's a key reason for the mutual funds to have continuously gravitated towards this model. That is the reason that they have all now individually, but collectively as an industry, chosen over the last 25 years to get this work done through an R&D agent. That's really the prelude to the entire story. What I will do is I will get into the analyst presentation now. We will spend about 30 minutes between myself and Soma Sundarama, CFO, to detail out the business to you. And then we should have enough time left for Q&A. So with that, I will begin. If you can flip to chart number, keep going forward. Next one, please. Yeah, please stay here. So like I was saying, CAMS, as you know, is a company which was born about 30 years back and has been in the mutual fund R&D business for the last 25 years. This business was done by a variety of companies in India, some Indian companies, both large and small, foreign companies, including large foreign banks. But over a period of time, all those companies have kind of fallen off. The foreign banks exited, the Indian companies also shut down. And for a period of almost the last 15 years, especially 2006 onwards, this has been largely a two-player market between CAMS and an entity called K Fintech, which is a key competitor. They used to be called Karvi Computershare earlier. Between these two companies, we've kind of dotted the skyline as far as this business is concerned. Another new entity entered this business sometime in 2011-12, tried to do this commercially, the MFRTA business, but could not scale. And then they exited and put themselves up for sale about a year back. And then it's back to being a two-party market, a two-entity market. Within this market, like I was saying, mutual funds have preferred the model to outsource the R&D work, which means the liability side operations work. And when I say liability side, just for simplicity of understanding, this is when investors are coming into a mutual fund, they're coming in and subscribing to units and bringing in monies. That entire operation from beginning to end, and I'll kind of go into scope in the next few charts, but just think of it as the A to Z of the liability side operation has been outsourced by mutual funds across India in the last about 25 odd years. Today, it's a 100% outsourced market, which means every mutual fund buys. If you call the 40 plus mutual funds, they will tell you that they buy the scope. They buy the A to Z, which is 100%. They don't buy it strip by strip, scope by scope, activity by activity. They just don't make any of this. They buy it completely from the R&D. Almost everyone has bought from day one, except for the older 2 or 3 mutual funds. Almost everyone has bought the scope from day one. And like I said, the first investor was onboarded by us. The first transaction was done by us as an R&D for these mutual funds. And then they all buy from one R&D agent. There was a time when a splintered provider model was prevalent till about 2005-06, but that model also fell off over a period of time, and then it's been a single provider for each mutual fund over that period of time. So that's been the buyer behavior. As far as we are concerned, like I said, we look at ourselves as a technology-driven, technology-enabled financial services provider, but that's essentially of the platform and infrastructure that we've constructed. So we think of ourselves essentially as a platform and infrastructure company, and then we produce services off that stack, which is enjoyed by investors, distributors, and the asset management companies. Like I had stated, we've been the market leaders in this industry for a long length of time, with over 50% market share for almost 15 years. The market share has been creeping up. It has crept up from the mid 50s to about just close to 70% where we are now. And within this, the share growth has been fairly accentuated in the last 5 years, where it is incremented by about 9%. From 61 to about 70% where it is right now. In terms of client behavior, the largest clients, the largest mutual funds in the industry have been our clients. So like you can see on the charts, 4 out of the top 5 and 9 out of the top 15. Well, another way to look at it is 5 out of the top 6 too work with CAMS. So typically the head of the industry has been with CAMS, and again for a length of time. This industry also has a peculiar characteristic that most mutual funds kind of shake hands with an R&D agent when they're starting business, and then they continue staying with them for a length of time. If you saw our top 10 relationships, our largest 10 relationships, then they're just short of 2 decades old, about 19 years on an average. And it is similar statistics for the entire industry, not just for CAMS. And therefore, client longevity is one of the key characteristics of this industry. Within this, we've been profitable, dividend paying and tax paying for a period of time, a no debt company. And we've had fairly marquee investors over a length of time. The company was founded in 1988 by a single founder. And he ran the company like that with that kind of ownership for the first 10 to 12 years. And then the first institutional investor to enter the company was the HDFC Group, which came in through HDFC Limited in the bank and through the employees' trusts. They've continued till date and will continue beyond the IPO. NSE, which came in as the other institutional investor in about 2013-14, they've been here for the last 6-7 years. Now, of course, the IPO is about NSE making an exit because they are under specific regulatory advice to wind down their shareholding in CAMS. But they did come with the strategic intent at the time when they came in. 2 different private equity companies, one which had made an entry in 2007 and then they exited over a period of time. And then Warburg Pincus, which has been an investor for the last 2 years and as of now the largest investor. So that's when you start thinking of the company, therefore, think of it as working in the MFRTA market. The MF market has had tailwinds for a length of time. It's been getting retailized successively. AUM growth, like I'll show you in the next charts, has been in the high teens to up to 20% in the last 5 to 6 years. And in an industry with those kind of tailwinds and with a kind of a 2-player architecture in the marketplace, we've been the dominant provider for a length of time with more than 50% market share for almost a decade and a half, over 60% for the last 5 years, close to 70% now. Highly profitable, dividend paying, tax paying, marquee set of investors, no debt company. And then the model has been such that it's not been easy to replicate. And while competitors are always there, like you know, the intensity of competition over a period of time has waned, which means, like I said, some of the players who used to do this business about 10 to 15 years back have fallen off, leading to a 2-player market. Within that market, in terms of just assets and the scale, the total asset size that we service today is just over 19 lakh crore in a market which is about 27-28 lakh crore, so just close to about 70% share. Within this equity monies or equity AUM, which represents now largely the long-term small savings done by households and small investors, that's over 6 lakh crore now out of the total AUM. We do over 30 crore transactions in a year, so a very transaction intensive nature of work. Within this, we support over 4 crore live folios. These are live customer accounts that we maintain for them, where customers hold the units and then they come and transact. Out of the 30 crore plus transactions, almost 24 crore are SIP transactions. And these are largely financial transactions. We are not speaking about non-financial yet. And within this, we have almost 300 terabytes of electronic data stored across various data centers across the country. And then you can see both in terms of return on net worth and EBITDA margins, fairly healthy trend, especially on EBITDA margins. And we will talk about margins in just a bit when we get to the topic of charging revenue and margins. And therefore, that really gives you the context about the company and the industry. If we flip to the next chart, please. You will see the context, the macros of the environment, and I know that most of you have been studying the environment, and a lot of this is covered in the CRISIL study. But I will just stay at just 2 parts of data. One, of course, is that the core metric, the core operating metric in the Indian mutual fund industry is the asset under management. Those assets have grown, like you can see, high teens. So a CAGR of 18% from 2015 to 2020, which means more than doubling from about 12 lakh crore in 2015 to almost 27 lakh crore in 2020. This was just the pre-COVID era. And then as per study and as per research, this is expected to continue growing and move up from about 27 lakh crore that it is currently to almost double the size to 52 lakh crore in the next 5 years. So that's one interesting metric on how the industry size has morphed over the last 5 years and how it could change over the coming 5 to 6 years. And similarly, just mirroring that kind of impact or that kind of phenomenon, if you look at the MFRTA industry, where we are the market leaders and almost a 70% shareholder, those revenues have grown 50% CAGR in the last 5 years, more than doubling from 400 crore to almost 900 crore from 2015 to 2020. And then just again, mirroring the AUM growth trend are likely to double again as per the report, as per the research, from about 9 lakh crore to close to 18 lakh crore in 2025. So that represents, like I said, the significant tailwinds in the industry, just led by significant market development, investor education effort that the mutual funds have made across the country. A lot of retail participation led by small households, regular saving formats where money comes in every month, largely through the SIP route. And while this has continued to happen on the liquid side, institutions continue to kind of up the participation for both short-term and medium-term monies through liquid and debt funds. Move to the next one, please. What makes us salient? Why are we salient? Why are we where we are? Why does the industry continue to prefer outsourcing all this work to one entity or one set of entities? Why is it efficient for them? And what is the work that we really perform? I think that's very important. And I will talk about value delivery, essentially what value gets delivered to the clients, to the mutual fund industry here, and why do they prefer the model? The first thing is the work. What scope do we perform? And on the chart, it's a busy chart. You see several boxes. You see a lot of activities. I will just try to take you through an intuitively easy to understand, easy to relate to kind of scope of services so that you can start appreciating what we do. A lot of you are in the distribution business, or you kind of bought funds for yourself, so you know how this works. But essentially, when a new investor comes into a mutual fund, and think of him or her as a brand new investor, they don't even have a KYC, they don't have an account with any of the mutual funds. When they come in, the account opening is done by us as the RTA on behalf of the mutual fund for the investor. A KYC has to be done for the investor. We do that on behalf of the asset manager, on behalf of the AMC. And then those KYC records are stored in a KRA company. The KRA company is owned by us, so that record keeping, record storage is done by us. Transaction origination, when the individual who's come in, the investor who's come in after the account is set up, wants to transact, a lot of those transactions originate either in our branch offices, our front offices, or they originate on our digital properties. Where they originate on an AMC's website or an app, or a seller's website or an app, it is supported through our APIs and our web services and our data. So we are at the back end supporting all of that. Transaction execution is our responsibility after the origination, which means all the business rules regarding the scheme, the investor, all of those are set up in a core system, and we help the transaction get executed, or some of them get rejected if they're not eligible. All the investor servicing in the industry is done by us. Once the investor comes in for the lifetime, the investor servicing is done by us. All the distributor servicing is done by us once the distributor starts business for our set of mutual funds. All the trade commission computation, which is brokerage computation on sales, this is done by us on our platform. All the payment and collections of duties and taxes like GST, TDS on dividends, stamp duty, all of that is done by us. The entire set of record keeping in the industry is done by us. So all physical records, all electronic records, emails, SMSs, logs of whether a particular SMS was sent to an investor, did it reach or not, because sometimes there are disputes, there could be signatures which are contested, there are wills which could be challenged in a court of law. All these times, on behalf of the mutual fund, we are summoned to the relevant authority. We will produce the records basis which the particular case will be progressed. Similarly, risk management activities like alerts for anti-fraud, anti-money laundering, all of that work is done by us. All process maps, training content, all of that is done by us. All complex products are developed in consultation with us. Almost the entire set of regulatory compliance is built and delivered by us. So when you think, like I said, of the liability side of operations, of the investor side of operations, when investors come in, when brokers and distributors are advising their clients and selling mutual funds, that entire A to Z of the operation for the entire lifetime of the investor and the unit holder is all done by us. When this is executed, it is executed in a very proprietary form, which means that the process is entirely designed by us. I'll talk about the platform later. I'm just talking about process execution. And within this, all the regulatory compliance, while it devolves upon the AMCs, is delivered by us because we do the process. So when the new requirement came in that we should not redeem money till the KYC of a person is complete, something like that, we will be responsible for delivering the entire compliance, because we will make sure that if a KYC record is not available, we will not let the person redeem their monies. And that's just one small example. There are literally dozens and hundreds of those things which play out in the real business world, and we kind of deliver the compliance part too on this entire set of operations. All of this is laid out like a buffet, which means all these services are not sold individually or by strip or in small boxes. They all sold collectively, which means mutual funds sign up with us and they consume all these services. They're stacked up like a buffet. You can come and consume everything, just any component that you like, as much as you like. And when they start consuming these services, they're paid for in a very simple to understand form. The larger part of the charging happens as a percentage of assets. We will get to the charging model, but it's an easy to understand model. It doesn't expand by every piece of scope, every new scope. And I give this example often with that when stamp duty became mandatory and had to be applied to mutual fund purchases, our teams would have been looking at the websites to understand the regulation. They would invite a consultant, a consulting firm, or a set of lawyers to interpret this completely. They would produce white papers and bulletins on this entire execution. We would present that to the mutual funds to gain their consent, and then we will write the processes, do the training, build the system changes. So write all the BRDs and system changes, drop the screens, the wireframes, all the code is written by us, every testing is done. And then the change goes live on the designated date. Within this, because the scope is not splintered, the mutual funds have just one neck to kind of grab, one throat to choke, which is us. We interface with all the other components of the mutual fund industry, whether it is the banks, it is the selling entities, it is payment aggregators, it is KRA companies, stock exchanges, whoever it is. And we play the integrator role in terms of delivering the outcomes that the mutual funds need in order to keep their investors and distributors happy and to make sure that service levels, gold standards and service levels are being delivered. They enjoy the service stack of one entity delivering all of this, A to Z, no finger pointing, no blaming anyone. Very easy to consume, very easy to understand the charging for, no RFPs needed when new scope comes in, no vendors to be identified, just one entity does all of this, all end outcomes delivered with all the regulatory compliance thrown in. So when you start thinking of value delivery in this entire business, think of this as the first component of value delivery, just the entire processing scope, delivered A to Z, beginning to end, with all new scope thrown in. Simple to understand charging, laid out like a buffet, and all the regulatory compliance is built into this. That's one pillar of the entire value delivery cycle. I'll flip to the next, please. If you get to the next chart. You will see, and some of you who studied classical outsourcing, and I come from a classical outsourcing background, you will see that in most outsourcing, the principal brings in the technology. If it's a bank outsourcing work, it is not the outsourcing entity which brings in the core banking solution. The bank has it. The bank also has the retail lending solution. It has its reconciliation and the treasury solutions. The bank owns the technology. In the case of this outsourcing that we are talking about, we bring in all the technology, which means the entire stack of technology. And I will go into just a few of the components, not all of them, just in the interest of time. All of this is owned by us, built by us, augmented, embellished, maintained, hosted by CAMS. What does this comprise? The core ERP kind of system where all the transaction origination, transaction execution, business rules, validations, payment and settlements, that kind of work is done. is owned by CAMS, used for the mutual fund industry. Mutual funds don't need to buy any of these softwares, any of these platforms. The industry level CRM, MF360 is our property, owned by us and licensed to the mutual funds. MFDEX is a industry data bureau run by us. The output is consumed both by CAMS service funds and also non-CAMS funds are members of this industry bureau. So both of them consume the end product. Transaction origination tools, some of you may have seen MyCAMS, corporates may have seen GoCorp, Edge360. You may have seen some of that in our advertisements too. All of those platforms are completely owned by us. And apart from this, various other tools, chatbots, CRMs for improving the efficiency of Salesforce, like MFCRM, a wide variety of APIs, a wide variety of web services, which is used to power AMC websites and seller websites. Today, you may be seeing your capital gains statement, your XIRR on your overall returns on a particular website, anyone that you prefer, but all those computations are being made in the CAMS engine before they're displayed to you. You're looking at it in a front end, but the heart is with us and all the processing is done by us. So this is the second big value delivery pillar of the entire model. All the technology consumed on the shared service, it is consumed by 70% of the marketplace. So it is built in one place, built by one guy, which is us, and consumed by multiple AMCs. Just a vast part of the overall Indian mutual fund industry kind of rests on this technology. Mutual funds don't have to buy this separately. They don't have to build it themselves. No maintenance, no hosting, no worries about cybersecurity, multiple copies of data, none of that. We take care of all of that. And this technology is the second biggest, you can think of as the second biggest value delivery kind of stream of the entire business. And then the third component of this, what makes the model very efficient and very different, is the big financial infrastructure that we've created. So if you see, we've created two kinds of infrastructure. There is electronic infra. We connected in terms of data exchange capability and linkages to all the 1 lakh plus sellers in the market, to all the payment aggregators, all the banks. You could have an account in any bank, including small cooperative banks. We'll be able to pull your monies from there with the efficiency that we have with any other place. And similarly, all the KRAs. Every entity which has any interface with the Indian mutual fund industry is connected to us. Mutual funds don't need to manage those connectivities, don't have to create that electronic infrastructure. You just come and plug into CAMS and you can transact with any of these entities at any time of the year, any time of the day. And then the physical infrastructure is a set of almost 270 plus branches that we've set up across the country. Mutual fund customers and distributors walk in there, get service, can make a request, start a transaction, ask for a tax statement, lodge a complaint for tax being deducted on dividend when they didn't want it. So all that kind of work, people visit our offices, and that's again one mass shared service. Mutual funds don't have to set up their branches in all these locations, and some of our mutual funds only have 20 or 30 or 40 branches. Only the larger ones may have 100 plus branches. Everybody else just kind of confines it to a limit, and then that large shared service is also consumed overall by the market. So those are the three large value delivery pillars: all the process execution, the A to Z of the liability operations side, all scope put in, all new emerging scope, also part of the whole model. All the regulatory compliance is pillar number one. Pillar number two then is all the technology that plays out in the market, which is needed for this business to run. Mutual funds don't need to own anything, just anything, in order to get functional. And then the third thing is this entire physical and electronic infrastructure that we have created over the last 25 years. And all of this works like a mass shared service. It costs only in one place to build it, and then everyone consumes it. And the reason I said that, therefore, this is a difficult to replicate model, because it has taken just a very long time to come here. It's taken us a very long 2.5 decade period to create all of this, to make it efficient, to make it contemporary, safe, secure. And therefore, while you know that every industry is competitive, other people have certainly tried and tried very hard. We are in a place by virtue of all the work that has been done in the past. That's about the model. Just flip to the next one, please. I quickly wanted to talk about some businesses outside of our mutual funds business. Mutual funds, like you know, is the core contributor to the overall revenue pool. contributes over 87% to the overall revenue kitty. Apart from this, I'll talk about three businesses which have salience and which could grow large over a period of time, all B2B within the financial services world and all non-labor kind of platform businesses. That's a sweet spot. We have an AIF and PMS servicing business. We largely do customer onboarding, customer service, fund accounting, and now, of course, we are leading into commission competition, which is brokerage. Manage over 77 AIF clients in the country, all domestic, mostly domestic. Completely own technology built by ourselves. All the linkages have been created. Like I said, we kind of work with over 77 of those funds, high ability to create margin. This part of the overall capital market segment has been growing very well. So very kind of positive on this business in terms of future growth and potential to do well. Similarly, the second box is talking about electronic payments. We have a platform called CAMS Pay. This was started as an adjunct to the mutual fund business in order to register the one-time mandates which came with SIPs, and then to use those mandates to collect monies from investor bank accounts through regular triggering. Now this business, of course, works with mutual funds, also works, the revenue has been diversified, so works with also NBFCs in order to collect monthly EMIs. And then the product classes are now being differentiated and diversified beyond just the ECS or NACH, going into UPI, and then over a period of time into credit card, debit card, and net banking. Again, completely proprietary stack of technology built by ourselves. All the linkages are done, handsome profitability. And therefore, this is a business which has headroom to grow, and we are very positive about the future on this. The third thing that I want to talk about is the insurance repository business. We are one of the 4 licensed insurance repository entities in the country with almost 40% market share. It's a small market right now, but we expect it could get to an inflection point in the coming years, largely led by A, consumer demand, B, more firm regulatory guidance in order to make the dematerialization of insurance more mandatory, and then also demand coming from the manufacturers. Again, we've kind of built all the technology and the linkages, and we believe that this could be one of the growth drivers for the future. So those are 3 businesses that we treat as irons in the fire, invested in them, build them to a certain scale, and we believe that they will have a significant role to play in diversifying revenue in the future. If you flip to the next one. 3 other things that I want to talk about. We have a KRA company, which is largely used for storing KYC records of investors who come into our mutual funds. Sterling Software, which is a 100% subsidiary, does work for mutual funds and AIFs, largely on development of website, transaction portals, and some BI kind of solutions and mobility solutions. They work largely for the acquired base of customers of the CAMS group. And then recently, earlier in the year, we've been licensed as account aggregators by the RBI. This business is in a pre-launch stage. Too early to talk revenue, but the various use cases are being debated. There is a lot of press on this, so we are hopeful to turn this into a sensible offering opportunity in the marketplace. I will pause here. I believe this would have given you enough view about the model and how we operate the core business and some of the smaller components of the business. I will hand over now to my colleague Somasundaram Somu to talk a little about financials, charging, profits, margins, dividends, that kind of stuff. And then we will have enough time left over for Q&A. Somu?
Thanks, Anuj. If you can move to the next chart. What I will do is next few minutes, I will walk you through the revenue landscape of the company, what are the key components, the underlying drivers and margins, cash, dividend policy, etc. If you look at our income, the predominant part of it comes from mutual fund business. 87% of the revenue comes from mutual fund business. 13% comes from various other businesses, some of which were discussed by Anuj. The key ones being the services to alternate investment funds, payments business, and the insurance repository and the insurance services. Within the mutual fund business, the significant part of the revenue comes from what you call asset-based fee. we charge few basis points of the assets that we service. For this purpose, the assets are classified into various categories. Equity, debt, and liquid are the key categories. Within that, equity fetches the highest realization, followed by debt, followed by liquid. Typically, these are one-to-one kind of contracts. The pricing is a telescopic structure. That covers the very significant part of the mutual fund business. The balance part, as far as the asset-based fee is concerned, it is charged irrespective of the channel or the mode through which the assets came in. So whether it came in the form of a paper transaction dropped at AMC office or a CAMS office, or whether it came through exchange, whether it came through the distributor portal, or whether it came through a CAMS digital property or AMC digital property, it does not matter. The asset-based fee is applicable irrespective of the channel through which the asset came in. On the balance part of the revenue, we charge certain additional fee for a paper transaction because it does involve certain additional efforts in terms of data entry, quality check, etc. So there is a separate fee which is charged. And a balance part of the mutual fund revenue essentially consists of out-of-pocket expenses which is charged to the client, and the call center services that we provide to AMCs, and also license fee that for the applications that is made available to the AMCs for use by their employees. So that pretty much accounts for the mutual fund business. Basically, largely it is predicated on the assets that we service, and within that the asset mix which would determine the revenue. As far as the non-mutual fund business is concerned, services to AIF has somewhat similar characteristic to mutual fund. So we charge few basis points the assets that we service, but with certain minimum business guarantee. And as far as the electronic payments business and the insurance business is concerned, they are mostly on the basis of transactions or the folio. Coming to margins, we are, if you look at, even go back and see 4, 5 years, 5 years, 6 years, you would find that our margins have been in the range of 37, 38% kind of a level, except for 1 year where because of certain year-specific reason, the margins dipped. By and large, otherwise, we have our EBITDA margins have been at around 37, 38% kind of a level. The profit after tax last year, our operating profits grew by 20%, PAT grew by 25%. And we ended the year with 174 crores of profits on a restated basis. If you look at the return on net worth, we have a very healthy return on net worth, 30, 32% kind of a level. In fact, it could be much higher, but for the fact that the bulk of the net worth is made up of cash and equivalents, which is basically invested in the mutual funds, which yields us a typical mutual fund kind of a return, debt fund kind of a return. Our business is an asset-light business. Most of the profit after tax gets converted into cash. We have a healthy dividend policy. We pay 65% of the consolidated PAT as a dividend, but in the past we have paid a higher dividend as well. Like I mentioned, the bulk of the net worth is made up of the cash and equivalents, and this year to improve the return on net worth, we have paid out a special dividend of 125 crores in August. So if you have to summarize the financial character of the company, I will put it this way. We are in a business which has a lot of tailwinds. It's a sticky revenue model, annuity kind of a revenue model, which is based on the assets that we service, a healthy profit margins. It's an asset-light business, therefore churns out a lot of cash, which is paid out as a dividend. If you, I think somebody has unmuted it. Okay. From a service stack that Anuj mentioned, I'm just trying to preempt some of the questions. If you have to look at our service stack, if you have to draw a comparison, we do transaction execution, we do payments and settlement. We do record keeping. We do the end-to-end investor servicing. Just one second, you unmuted. We do end-to-end investor servicing. If you look at comparables in the securities market, typically these functions are carried out by multiple market infrastructure institutions, which is what gives the company its strength. So with this, I will take a pause and we'll start taking questions.
Thank you, Mr. Kumar, Mr. Somasundaram, for taking us through the presentation and your experiences in working towards a common goal of becoming a business services partner to your clients. It's commendable on how the entire team at CAMS has steered the ship to make the organization today India's largest registrar and transfer agent for mutual funds. It would also be important to note that the company is the country's fastest growing RTA. We hope that the attendees have captured enough and more understanding about the CAMS business avenues and financial soundness. Before the floor is open for participants to ask their questions, I would like to reiterate to type your name and organization details in the Q&A chat box for the moderator to take note and address your query. Note, in interest of time, we will be restricting the questions to about 15 to 20 only. Repetitive questions will be skipped or clubbed. So, sir, moderator, can you please get everyone on the grid? And the first question comes in, just to ask the management, to just explain your competitive advantage and client stickiness.
Yeah, sure. So I think I'd gone deep into the value delivery model, stating that delivering the end outcomes, one single entity delivering all the end outcomes on all the processing and the necessary compliance, the entire stack of technology. So think of, let's say, there are 16 large, medium, and small AMCs we service. And if each one of them had to go and build the entire platform that we have built, build the entire financial infrastructure that we have built, they would end up spending about 60, 70, 80% of the money that we have spent to do this. And the requirements are very multi-layered, very nuanced. The intimacy to the market, to the regulation has to be very high. And it takes a long time to build all of this. And therefore, just replicating the model or for the AMCs to insource this and do it themselves is not a great option, because it will be more expensive, it will be more cumbersome, and it'll take many, many years, maybe decades, to get to this level of finesse and this level of capability. That's really the competitive advantage. It is not that there were not other players, I didn't name them, but both foreign banks and Indian companies used to do this work till about 2005-06. One of the banks persisted till about 2012, 2013, and there are people who do this work overseas, but they fell off. A new entity came. This was a JV between two large financial groups, one Indian, one overseas, and they set up a commercial RTA business. And then after 7 or 8 years, they decided to do a wind down. So the secret sauce of the competitive advantage in this industry is understanding of processes, understanding of compliance, multi-layered, nuanced kind of reality of the entire processing setup, having the financial infrastructure, and most importantly, having the platform. It's taken us 25 years to build all of these things and get them to the current stage. And therefore, while I will never say that it is not replicable, it's a tough task to build something like this easily.
Thank you, Anuj. There's a question coming in that, can you give us some light about your revenues going forward, considering that net inflows into equity schemes in MFs are declining?
So think of it this way. We spoke about AUM compounded growth rates, and we spoke about high teens, about 17, 18% in the last 5 years. And then you've seen the research which points to almost similar growth rates coming in the future. The mutual fund revenue, which is the primary source of revenue for the company, is predicated largely on AUM growth and grows with a small handicap to the AUM growth. So if AUM growth in the past years was 18%, our revenues would have grown about 13, 14%. Therefore, from an overall asset growth perspective, and you can look at any metric, financialization of savings has begun to happen in India in the last many years. Households are diversifying out of physical assets like gold and real estate. And within financial savings, just the tax efficiency and the return capability of mutual funds has been superior to other comparable instruments, including bank deposits. So therefore, that provides the overall set of tailwinds for the industry. And we believe, and the research that you and I are reading points to the same fact that that trend could be an enduring trend. And therefore, we believe that that phenomenon is a secular phenomenon which will carry on for a length of time.
Okay, while in the presentation you had shown about your insurance repository business and your AIF business, can you just detail out your diversification plans ahead a little more?
So in the past, like you would have seen, non-MF revenue has been in the teens, about 12, 13% of the overall revenue stack. Through the growth of the AIF business, through the CAMS Pay platform and the insurance repository business, we have had three things which have kind of grown to a reasonable shape just in terms of business operations. Both AIF and the payments business are of a critical mass. We've been selling quite well, and we have the technology platform to continue scaling them and grow market share. Insurance repository has to, as a product class, has to go through a level of acceptance. Like I said, that inflection point may be 2 or 3 or 4 years away. But we believe that whenever that happens, that market will also go through significant growth. So those are the three business that we are putting our bets on. And then, of course, like I said, we are now a RBI licensed account aggregator. It's very early to discuss revenues there because revenue streams have yet to kind of firm up, charging mechanisms have to kind of crystallize. But just given the several use cases, we believe that that could become an important component of a business stack to over a period of time.
Okay, after this OFS, just to give an indication of, what is the shareholding pattern going to be, for the promoter and promoter group?
The Warburg would continue to hold 31% of shares. The HDFC group would continue to hold its shares at post-issue, which is around 12.5%. And the rest of the current shareholders would also continue.
Okay, sir. Can you also just explain on, any kind of threat or opportunities, in your business?
So from a threat perspective, we believe that the model getting ripped is an unlikely event, either through head-to-head competition or through insourcing or through fintechs or any similar entities, any technological interface which comes in and can do this much better and much cheaper. So basis how things are presently, we believe that it is a unique model and the model will stay. From a operations perspective, day-to-day operations perspective, we certainly believe that there are two things that we have to be very watchful about. One, of course, is that we deal with very large amounts of money. And given the large amounts of money, any error proneness, any defects, any risk events, which are even very, very small in nature, but just given the fact that the amount of monies we deal with are very large, they could impact business. And therefore, a lot of our effort and focus is on de-risking the business, automating the business, and making sure that our risk policies, procedures, and practices are completely up to the mark and reflect the gold standard. And the second thing is that with increasing digitization and various digital interfaces through which data gets exchanged, investors come in, they transact, monies come in, data privacy, data security, prevention of data leakage becomes, again, a large area that we are focused on because that could present the other amount of risk or threat. I'm sure all of you are kind of closely keeping track of cybersecurity as an important metric for the financial services sector, and the threats of attacks and various other forms of breaches that can happen. So those are the two areas that we are very focused upon, which is financial risk and financial defects, and then cybersecurity and data-led risk and that kind of defects. And like I said, the management team has been very focused on driving the agenda on these two items. I would also like to draw your attention to the fact that last year in 2019, we were at par with the best in the country in the FSS sector, in the financial services sector, on the BitSight score. BitSight is a leading US company which gives you a scorecard, which is a good indicator and outside-in indicator of your cybersecurity strength. We were rated at a score of 790 last year, at par with the best banks, the best insurance companies, the best financial services entity in the country. This year, we have incremented our score to 800. So we continue to be focused on these aspects. But yeah, that is what we perceive as a risk that we need to manage very well.
Okay, can you explain, what has been the impact on your business models with MF shifting to paying charges per folio instead of basis points on AUM as currently?
Lalit, the current revenue model is based on the assets that we service. It has been that way for very logical reasons. If you look at the scope of service that we do, it is not a simple transaction execution. The scope is extremely wide, which is what I was trying to do cover in my financials presentation. It includes transaction origination, it includes transaction execution, it includes payments and settlement, it includes brokerage computation, it includes end-to-end investor servicing, and a lot more. The things like compliance, etc. Therefore, it is almost impossible to get into a revenue model which is either transaction based or a folio based, because this is an industry which is prone to changes on a weekly basis. Therefore, the revenue model has to be such that it is able to absorb any kind of a scope change without the necessity for getting into a commercial discussion with every single activity, new activity which comes into the play. And therefore, at this point in time, we do not see any change in the revenue model for the business.
Okay, thank you. So there's a question on the reason for the degrowth in Q1 FY21 in revenue from operations on a year-on-year basis.
Yeah, so Q1 21, as you know, the entire world was impacted by the pandemic, and the mutual fund industry was no exception, and CAMS also was no exception. And I will cover it in two parts: what happened to the assets, and therefore the asset-based fee, and also what happened to the rest of the revenue streams. The assets, as you all know, end of March, impacted by the valuation drop that we saw in the market. It impacted the assets that we service also. The equity assets came down very sharply, almost in line with the correction that you saw in the indices. So was the case with liquid and debt funds, because it was customary for those assets to go out in March and come back in April. But however, due to pandemic, the return of those liquid assets and debt assets did take time, because coinciding with the year end, there were other developments associated with one of the mutual fund player. However, by around the end of May, we could see that almost all the non-equity assets were coming back. And as we speak, our non-equity assets, which is debt and liquid, were at par or more than what we had in February. However, equity assets, while it has come back fairly sharply, almost in line with what the improvement that we have seen in the secondary market, it is still 5 to 6% below the levels that we saw in the February. Now, this had one impact on the asset-based revenue. Number two was that due to lockdown, and the entire April was almost the entire country was locked out. AMC offices were closed, and our offices were closed, and therefore the paper transaction volume on which the transaction revenue depends on, it came down very sharply. So even in June, only part of the offices could be opened. So these two factors impacted the revenue in Q1.
Okay. There's a question asking that, how do you justify, the 35x trailing valuation, especially when you are at the bottom of the market infra value chain?
Lalit, I won't answer this question directly, but I would just guide the people to look at the valuations for CDSL, maybe which performs one of the many functions that CAMS services. That could be one, this one. Number two is that if you look at CAMS, we are a mutual fund ecosystem player, and therefore it is more like a, so that's the way you have to look at CAMS.
Okay, another question states that your competition seems stressed at 1% net margin and 3% return on equity. Would you consider an aggressive pricing approach, to move the market towards a monopolistic situation?
So let me take that. When we look at competition and we look at the marketplace, we certainly want to gain share and gain new logos. I don't think we ever think of it as a duopolistic or monopolistic situation. And whatever advantage or disadvantages may accrue out of those situations, we don't look at it like that. So we continue to engage with the market. We continue to fight very hard for every new mutual fund or AIF that comes into the market, and also base clients which are serviced by the competition. And our pricing, although I will not claim that we are an aggressive price player, we are a value player. If you talked in the market, you will see that CAMS sells and offers value. And in a lot of cases, we are paid premium pricing for that. So I will not describe ourselves as a pure value player, but we deploy different strategies to kind of attract new clients to come over, but never with the objective of becoming a monopoly. I don't think that's how we structure the argument. The way we structure the argument is that we need revenue and share growth, and whatever means take us there, those are the means that we deploy.
Okay, so there's another question that comes in that, how would you differentiate yourself from a BSE Star mutual fund platform, which is gaining traction from AMCs? Won't it affect our business?
So like Somu was trying to explain, and like you saw in the presentation, we were talking about the A to Z of the liability side operations work for mutual funds that we play out as a registrar and transfer agents. Transaction origination is a very small scope. It is an important scope, but it's a small scope. And like I said, between onboarding a customer, transaction origination, execution, distributor service, customer service, record keeping, compliance, risk, there are multiple things that we end up doing. Platforms, especially the stock exchange platforms, do compete us in a certain place, but obviously the value delivery is I would say a single line value delivery just in the transaction origination space. So while they compete, please don't think of it as a head-to-head competition. A head-to-head competitor is a KFintech, which is another registrar which does the full scope. Everything else competes only in the specific scope of transaction origination.
Okay, so could you just enlighten us on your data security practices? How safe is the investor when it comes to CAMS?
Right. So like I was talking and I alluded to briefly during the presentation, that risk of attacks, whether it's ransomware or phishing or any other form of breach of perimeter, and risk of data being leaked out either by employees or in transit or because we didn't encrypt it, all of that is a very high priority for us. Any data breach or any data risk event can be considered reputational, and of course, it does create a trust deficit. So as far as we are concerned, we have been working very hard over the last 3 to 4 years to improve our cybersecurity posture. The regulator SEBI lays down specific guidelines in terms of what they would like us to achieve in terms of cybersecurity. So that set of guidelines came out in 2017, and we were able to comply very quickly. We also have a technology committee which advises the management and the board on cutting edge cybersecurity practices, which we need to implement. It comprises of independents, largely coming from industry and academics, professors from IITs, those kind of people. And that committee has been in place for the last 2.5 years to advise us. And then from a scoring and from an assessment perspective, I'd spoken about BitSight, where we had come out, like I said, the best in the land in the country at par with any bank, any insurance company, any financial services participant in India. Last year in 2019 at a score of 790. And this year we've incremented beyond 790 to a score of 800. BitSide is a good view to one cybersecurity status. It is not a all-encompassing view. It's not 100% coverage, but it's a good outside-in view. But we are very comforted that we've been able to bring ourselves to a level where we are required to be, and where we have created enough security practices, enough consciousness in the employees, and we've deployed a set of tools and techniques which is able to protect the data very efficiently.
Okay, sir. There's a question that, how is the contract with the AMC structured? Is it, as the MF, AAUMs go up, will the AMC pay lesser?
Yeah, so the way it is, the contracts are perpetual contracts with provision for price reviews at periodic intervals. Yeah, most of the contracts are slab based, and therefore, as the assets grow, the average realization drops, which is why our revenue has been growing with a handicap to the asset growth.
Okay, sir. Is there any other question coming in from the participants? Just give me a second, please. I think that's it for now. All the unanswered questions will definitely get responded back to, separately. Thank you everyone for showing interest in knowing more about the company, its leadership and its future potential. I would now like to call upon Mr. Jagat Dave to make the closing speech before we end towards webinar.
Thanks, Lalit. A very good evening to all of you. On behalf of CAMS and the BRLMs, it is my pleasure to express gratitude and these closing remarks to yourselves. These are very interesting times for CAMS. It's a very memorable time. It's a milestone in what has been a fantastic journey of hardcore execution built on a technology backbone and an infrastructure which is globally comparable and best in class. The business model and the moat around the business model is built upon not only the technology architecture, but more importantly around long-standing client relationships, and more importantly a factor of trust, which is not very easy to build. And that is the moat one is talking of. So kudos to Anuj and the senior management team of CAMS for having delivered this consistently over all these years and has maintained market leadership. We wish and hope that this will continue, the market leadership will continue. On behalf of CAMS and the BRLMs, I thank all of you once again, and we look forward to your enthusiastic support and cooperation during this issue. Thank you so much.
Thank you, Mr. Dave. Esteemed audience, we've now come to the end of the webinar. We look forward to your participation and support in making this initial public offering a great success. Wishing you all a great day and keep safe.
Thank you.
Thank you.
Thank you.